The cost of shipping commodities has fallen sharply in just 5 weeks. Rates are down 43%. So what does this signal about the commodities boom? Michael Whitney joins us to explain what's going on in this industry.
Well, 7 consecutive days lower, and it's a very simple problem. There's just empty ships. Take a look at this picture. You can see exactly what's going on. The Malacca Strait, this is the busiest shipping lane in the world. This is right around Singapore. Look at this, boats everywhere. More and more boats.
A lot of passing lanes.
Tons of boats there. You can pass everywhere. It's reported right now that there is enough boats there bigger than the U.S. and British navies combined. So lots of empty boats means freight rates are going to be struggling.
So what are those boats doing there? They're just staying afloat?
Sitting there waiting for cargo right now. We're talking about dry bulk shipping rates in particular here. We're talking about the big boats that move things like iron ore, which is used to make steel, coal, which is obviously used to make power, bauxite, which is used to make aluminum, and grain. So a lot of people look at this, and commodity analysts look at this as a proxy for macro demand. So as freight rates go, so go the commodity markets. You can just see just what a bloodbath it's been in the last 5 weeks in these markets.
Here's our Baltic dry index off 45% since June 3rd, according to your graph. That's pretty unbelievable.
Yeah, certainly down a lot lower, and a lot of people are citing what's going on in the Chinese market. I mean, Chinese iron ore imports down 14% month on month. People like Dan Greenhouse, the chief economic strategist for Miller Tabak, he thinks that this is a very negative sign for commodity prices in general. And if you look at the correlation between the CRB, which is the broadest commodity index, you can see it here on the graph, and you can look at the freight rates. You can see the freight rates, they actually precede the movements in the commodities. You can see on the orange chart here, the orange line, that's moving downward here, but commodities are going sideways. A lot of people think this augurs a negative sentiment for the commodities market in general.
All right, Michael, hold there with us. We want to now bring in our guest, Piero Carello. He is Vice President of Commodities Derivatives at Mitsubishi-UFJ. And again, Michael is here with us. So, Piero, welcome. Thanks for joining us. You guys are really experts at this, at the dry shipping industry. What, though, does the trend say about the broader case for the economy?
As Michael was saying, it's quite an interesting link between commodities and the freight index. I mean, basically, it represents what the core countries need. As Michael was saying, we're talking about the building blocks of economy, so construction, food to a certain extent. So it's really a good indicator that as this is coming down, it doesn't look like everything's rosy just yet in the importing countries.
It's interesting, though, right? Because people are talking about economic rebound, yet we have this indicator showing that, well, the demand really isn't coming back for certain goods.
Yeah, that is very interesting. However, it's difficult to say. We've had a sort of what we call a dead cat bounce recently, and it was mainly a response to the Chinese stimulus package, where there was large imports in the last couple of months, and we saw a bounce of that. So again, that highlights what Michael was saying of the correlation virtually instant between the freight rates and the actual demand of commodities.
Piero, it sounds like it's not a very good business right now to be a dry bulk shipper. Tell us a little bit more about the supply and demand for the commodity itself of ships.
Actually, that's quite an interesting point, and is the point we are looking at the most at the moment. We treat freight effectively as a pure commodity. So we look at the supply side, and over the next 3 years, we are in line for about 50% increase on the amount of tonnage available on vessels. While on the flip side, if you look at the demand side of that, it's pretty much flat. And then you add to that the fleet is on average about 15, 20 years old, which is relatively young in terms of vessels. So with scrap prices low, we can expect owners to keep these vessels sort of operating in the market for a good 5, maybe 10 years. So from that perspective, I would say owners are in for some, I wouldn't necessarily say tough times, but certainly nothing near as rosy as they were last year.
What could change that, Piero? I mean, is India possibly on the horizon as something that could breathe some life back into the freight markets?
India, I think so, is a country we watch with great attention. It's got enormous potential. Specifically, I look at the power sector. They have plans to build a large number of mega power stations, which will enormously increase the amount of coal they will require. So that really could be the swing factor, if you allow the term, the new China.
So, Piero, Lori, again, you trade the prices of these shipping contracts, if I'm understanding correctly. Is this something for an average investor?
It is very difficult. First of all, it's a very particular market, so you require very good information from all the commodities. Secondly, what we trade are derivatives, therefore they carry certain difficulties inherently. And the market, although it has grown significantly in the last few years given the volatility, it's still at a relatively young stage. I wouldn't qualify it as a fully mature market just yet, but one of these days, perhaps.
We'll have to leave it there. Many thanks to Piero Carello, Vice President of Commodities Derivatives at Mitsubishi-UFJ, and my colleague Michael Whitney, who covers commodities for us.